This is Jason Maggard from Modern Money Method, and today's episode I decided to title it Tipping Point. And the reason I came up with Tipping Point is we have something going on here that's pretty dramatic. Home buyers hit with the U.S. mortgage rate surging most since 1994. And what makes this really important is what you want to see here is if we go back, this here is a historical data of average 30-year mortgage rates in America. And what we have here, if you go all the way back to 1994, and I know people go, oh, 94, what's that got to do with anything? Well, it has a lot to do with something, because something that a lot of people are probably not aware of is these are interest rates. I know they look shocking to most people, 7, 8, 9% in the 90s. But something I want you to notice is the first column is the lowest rate of the year, and the second column is the highest, okay? Why that's important is if you'll notice, most of the time, even when rates were way up here, they rarely varied by more than 1% throughout the year. And so in 94, it was quite dramatic. Rates had dropped to about 7%, and they rallied up to 9.25%. That was a 2% quarter change, which on a percentage basis was only about 30% from 7 to 9.25%. That's a 30% move. As you can see, most years have less than a 1% range. There's here 6.5 to 7.2. And especially as you come more modern day into the 2000s, there you have a low of 6.5, high of 7.25. Here you have a low of 5.5, high of 6.3. Rates do not move that much throughout the year. So they can move, but on a dramatic basis, not so much. Now, what we have going on here, what I want to show you is what I generally track for 30-year mortgage rates. And this is actually the 5-year U.S. Treasury. And we won't get into the details of how the rate comes about and things of that. It has to do with buyers and sellers of U.S. Treasuries. But what is most important here, I want you to really look at, is we have a chart here. This is just the past 6 months. And if you see this change right here, this plus 0.187, that's just in the last day. That was on this last Friday. And the yield on this went to 2.561%. And once again, you might go, that doesn't sound very high, Jason. But what I want to show you is this is a dramatic move on a single day basis. You're talking that is around 7 to 8%. Rates went up by that much on a percentage basis in one day. Here's where it gets crazy. If you go right back here to March 1st, where I got lucky, I had a few people that were really ready to move when need be. And I was able to lock them in on March 1st here when we had this yield on this index, which mortgages then are another layer above. They're usually about 2.5% above this. So we have 2.56 here. If you add 2.5 to that, we're going to start hearing about 5% home loans here really soon. Well, this index was only 1.5 less than a month ago. So it has risen an entire percentage point. On a percentage basis, that's 67% in less than a month. Now, when we look at this 6-month chart, we've got to really just ask ourselves what's going on. Look at this thing. This thing has just rocketed up. Over here in October, it was at under 1. So that's why rates were around 3, 3.25 in that range towards the end of the year. It stayed very steady until right around Christmas time, and then rates started taking off. They paused a little bit there at the beginning of the year, and then they had another rise up. We thought we had a break coming because they got as high as 1.9, just under 2, and they dropped to this 1.5, but that turned out to be very short-lived. Now, what I want to show you is we've kind of been lulled into, for lack of a better term, like a coma, I guess. So this chart here only goes to 2019. And this chart, once again, is the historical average throughout the year of a 30-year Fannie Mae Freddie Mac mortgage, so a conventional loan. And I will show you, I have 2020 and 2021 on my data sheet. But look how we've been lulled into very steady rates for the year. You go all the way back to 2009 here. Look at this, a low of 4.7 and a high rate of 5.6. Low of 4.2, a high of 5.2. This range has been very narrow. 2014 here, look at this. Rates were pretty much flat all year. 2015 too. Look, you only had a half point move in the whole year of 2015. A half point move. We just had a 1 point move in 3 weeks. This is important, folks. So anyway, you can see that we've been lulled to sleep here with thinking whatever the rates are, they're going to be roughly that throughout the year. Well, you know, when rates were 2.5, 2.75 there a year and a half ago, towards the end of 2020, who thought we were going to be at 5% today? So this is my bring you up to date chart on mortgage rates. And as you can see, just since the beginning of this year, this is just the data that I collect. So we are now at 4.875 on a 30-year fixed. And why I say we're at a tipping point is this is what is very important. I have created, so I have a lot of data that I've tracked over the years, kept it in different notebooks and things of that sort. I'm starting to put it now into spreadsheets and into Notepad where I can share it. And later here, I'm going to have charts so that we can look at those charts together, which this would really show up in a chart form, super clear. But I actually wanted to show you the underlying data. In the future, I'll probably just share charts more. So right now, this is only Pierce County that I'm dealing with. And there's very important things, even though, we have investors and we have second home buyers and we have people putting, $100,000 down, paying $50,000 over appraised value. At the end of the day, 80 to 90% of all buyers have to get a mortgage, whether it's conventional FHA or VA. And they don't have 50% down. They have 5, 10, 20% down. So what I've done here is taken one of the most common mortgages just to put it in perspective. Yeah, you could do this on all little different subsections, of $1 million homes and people that make $200,000 a year and, just VA buyers. But I went just with the conventional because it's something that I've tracked for 20 years. What I want to show here is we have median household income in Pierce County. Right now it's $87,000 a year. So that's all the households together. I believe there's about 350,000 households in Pierce County. That gives us a gross monthly income of $7,250 a month. Why is that important, Jason? Well, 80 to 90% of the borrowers need that income to pay their bills. And one of the bills, if they're buying a house, is then the house payment. As you can see, we had rates of just 2.875 July of 2021, and we're already at 4.875. So this is what I'm talking about, a tipping point. These rates have gone up dramatically. We don't know exactly what the average March house price is right now. We'll get that information in about 2 weeks. I'm just going to estimate it at $530K in Pierce County. So if you take the average home buyer and they put 10% down, and then I calculated property tax at 1%, they would have mortgage insurance. I'm presuming they have good credit, 0.5%, and then insurance of approximately 0.2% per, and this is on a monthly basis. So that would be like insurance, $106 a month on a $530 house, which that's about what I see all the time. So a person right at this moment picking a house has a 700 credit score, 10% down on a $530,000 house. They're looking at having a $3,425 payment. Now that's real numbers that are coming out of this, and this number here, this is before taxes, before deductions and things of that sort. We have now just hit the second highest I've ever seen percentage of gross income that is dedicated to the house payment, 47.2%. Just happened with these house prices and these interest rates. And I want you to look here, just in January, Houses were less and interest rates were only 3.5. So we're only talking 2 months ago. Just 2 months ago, you had the same house would be 29.56. That's only 40.78% of your gross income. And when I say only, I'm just meaning in comparison to the 47.2. Now, a lot of you know me that I've been in the finance field in the mortgage business and real estate for over 20 years. And in 2006, 2007, I started getting very worried. And I even have evidence I got worried because I sold more than half of my portfolio going into 2008. The reason I did that, I want to show you, we'll go down here. I've taken this chart all the way back to 2004. Now, we're just going to look at the same columns again. We have the average interest rate. So I averaged it for the whole year out here in Pierce County, the average house price for the year, and then gave us a monthly payment. Now, as you can see, the payment goes all over the place. From 2004, we have an average house payment in Pierce County of $1,578. Went all the way to $2,248, and then look at this, came all the way down to $1,371. That's when houses were crazy cheap. Then we actually had a pretty high payment here. The very end of 2019, we were at $2,441, and that was when rates were in the mid fours. Well, rates started coming down, so the payment started getting more affordable. And that's why you saw house prices have no issue rising, was because people could afford it on a percentage basis. So in 2004, I was tracking this number and it was under 37%. Taking this average home buyer's payment in relation to their income. Well, in a very short period of time, as house prices, so the current house price jumps are not unprecedented in Pierce County. We experienced 10 to 15% jumps in the early 2000s. We have 225 and we went to 261, 293. Very similar. Look at this house payment go from 1578 all the way up to 2200 in just 3 short years. We peaked out at 48.4% of a person's gross income, so not their take home, was having to be committed to the house payment. I know a lot of people blame the 2007, 2008 crash on the liar loans, the ninja loans, and all that. Those were a very small percentage at the very end. Did they contribute to the crash? Yes, definitely. But you have to realize 80, 90% of the mortgages up before that were solid borrower mortgages. People were just starting to get very stretched on what they felt that they could afford on a monthly basis, and it kind of pushed them to the limit. Now, there's lots of reasons that extended and it became the great financial correction. But what you have to look at is when things got tough and people were less certain about everything being fantastic and rosy in the future, it got down where people were only willing to commit 26% of their income to their mortgage payment, meaning they needed more flexibility, they needed more reserves every month because they didn't exactly know what was coming. Well, as the market steadied out in 2013, 14, 15, we saw the economy was recovering. People started having a higher percentage, being willing to commit a higher percent of their gross income to the house payment. We see 30%. I didn't do every one here because it would have been really crowded. And in 2018, we got to 3702. And I truly thought, hey, we are not making this mistake again. Because if you go back before into the 90s, it was always into the mid upper 20s. That's been a real standard for house payment. So when we crossed that 40% threshold, that's why I was like, this is getting interesting. And if you notice, we also had rates increasing at that point back in the early 2000s from the high 5s to the low 6s. I just thought people are not going to fall for the skin. They're not going to get up there where half of their gross income, not their take home. So we're talking 60, 70% of their take home is going to a house payment. You still have utilities and food and gas and all those things on your monthly budget. Well, anyway, so in 2020, we had an average of about 36. It actually dipped down because people's wages went up. We had the stimulus and we had people getting pay bumps and rates went rock bottom. So it was easy for houses to skyrocket 10, 12% in 2020 because it actually became more affordable. It went from 37% of your income to only 36, even though the house price went up. And then we had another big jump in 2021. And look at this, it still was fairly affordable because people's income was increasing, rates were low, so you could go to a $470,000 house. You're still at 38, 39%. We're getting up there. We're approaching this 40. It's getting a little nervous. By July, we were at 39.82. The house payment on an average house with the interest rate would be 27.21. By the end of 2021, we crossed the 40% threshold. Rates started creeping up. Prices are up. $2,900 house payment, 42% of a person's gross monthly income in our county. Well, it took a little dip down because wages went up again in 2022. Now, the wages are a moving thing, so I'm taking annual time shots here. So you have to realize, like, probably by the end of 2022, the average median household income will be 90, maybe 92,000 in Pierce County. So if everything stayed stagnant on this part, then you would see the percentages come down. But we have crossed into that threshold again of 47%, which is getting very, very expensive to have that. We hung out up there for a little over a year, about a year and a half back in the early 2000s, and then we experienced a correction. So we are at a tipping point because unless interest rates do a quick reversal back to 4 or less, or house, I don't see us hanging out up here close to 50% of people's gross monthly income going towards a house payment being something that is sustainable. People are going to just, I get it that supply is short, but when your housing payment has gone up, $600-$700 just in the last few months, that's not chump change. That's $7,000-$8,000 a year. That's not, that's not just an extra $100 here. We can't go out to dinner, cut a couple coffees out. That's like, hey, you know what? We no longer eat out, or hey, we no longer drive. So wanted to share this information. I'll track it on a monthly basis for you. And so this is one of my biggest indicators of where we are in the housing cycle. And it's the percentage of gross income in an area. And you can do this. You can break it down even into smaller areas, cities and things like that. The government gives pretty good statistics on median house prices. But this is what I track. Is this in relation to what people are spending? And we're up there at the high point. We're at a tipping point. Boy, let's hope these rates don't either keep going up, or even let's hope they get out of these 5s and back down in the 4s. So, but don't know what's going to happen with all this inflation. So thanks for coming in. Thanks for listening to me. And I hope you got something beneficial out of this. All right. Have a great day.